Hello and welcome to this year-end special on TMS, where today we'll be dissecting and in fact analyzing all the investment instruments basis on the triggers and their movement and the kind of returns you've seen in your portfolio. And today the focus will be on the debt market. How has 2023 been for the debt market, and what are the triggers and cues for you to have a strategy in 2024? With me for this, I have Mahendra Jajoo, CIO of Fixed Income, Mirae Asset Management Managers. Hello, sir, and welcome to TMS and this special edition, which I'm calling it as a year-end special. And clearly, we'll be talking about the debt market. I want to understand the year when we started in June 2023. We all were anticipating or hoping for rate cuts to happen, but then we saw there was geopolitical tension and various triggers and data also that turned it around. And now the rate cut scenario has gone to 2024, maybe 6 months, 8 months down the line, depending on the data again. But let's analyze the beginning of Jan 2023 and the way things have changed. A lot of pessimism in between, but then we saw things changing in December. Overall, first 6 months of 2023, how do you analyze it?
First of all, thank you so much for inviting me. And as we saw in 2023, things have been very volatile. And as you rightly explained, the sentiments have gone from extremely negative to extremely positive, and that is also a backdrop which the investors must consider while getting affected by the volatility. So we had started the year with the feeling that the economy is going to get into recession, especially the US economy, and that the high interest rates might have impact on the banks. And then in March 23, we saw the Silicon Valley Bank collapse. And that's the time when the market started to believe that the financial system is under threat, and the stability required for the banking system to function normally in US will mean that the Fed will start a series of rate cuts like they have done in the case of the past crises. And then in this case, the Fed took a different approach, and rather than cutting rates, they bailed out the Silicon Valley Bank, and then there was another First Republican Bank, couple of other smaller banks. And then rather than cutting rates and injecting liquidity at the gross level, they provided a liquidity facility to the banks to borrow against their holding of securities at par, and that cooled down the market. And therefore, but at that point, the market had built in an expectation, almost 100% probability of a rate cut by July, August. But then, as the things turned out, the Fed continued to hike rates. The inflation continued to show a lot of stubbornness, and the inflation numbers were not giving comfort, especially the core inflation did not come down as much as expected. So Fed hiked the rates 4 times between February to October by 25 basis points each. And every time they kept revising upwards their projections for the terminal repo Fed rate. At the same time, we saw a very good traction in the economy. The US economy grew at a rate of 2.1%, and then at the rate of 4.9% in the last quarter. So the whole market expectation of the economy getting into recession, and then the Fed cutting rates because of the weight of the tighter liquidity, that did not materialize, and therefore the market eventually reconciled with the Fed guidance, and the 10-year yield in US saw a sharp rise to 5%. Now, part of the reason for the hike or the rise in the 10-year yield in US was also the gap between the demand supply, because the overseas central banks and the overseas investors have been kind of reducing their holding of the treasury securities. The US Treasury was building up its cash balances again after the debt selling crisis, and the Fed continues to sell bonds of about $95 billion per month. So cumulative impact of that, we had a very, very pessimistic scenario sometimes in October, when the Reserve Bank presented its previous policy, and Reserve Bank also guided for open market sale operations, and then they guided for the inflation target to be 4%. Somehow after that, we saw a sharp slide in the US inflation number, and that led to a dramatic turnaround in the sentiments. The Fed chairman also, in couple of public appearances, talked about the possibility that the rates may need to stay longer, but there may not be any further rate hike. So I think we have seen that roller coaster of the sentiments swinging from extremely negative to extremely positive during the year. It's a typical behavior of the market, but the investors need to understand that they need to keep the big picture in mind. So, what is the big picture at the beginning of 23, and what is the big picture at the end of 23? At the beginning of 23, inflation is still very far away from the central bank's target. In spite of all the negativity, the economic momentum was reasonably strong. The consumer spending has been the central force of the US growth. The consumption has been the central growth driver for India as well. And therefore, at that point, to prematurely expect that the rates will be cut was not fair. And therefore, the investors should have been prepared for a hawkish environment. At the
Right.
same time, because everyone knew that the banks are, the central banks are hiking rates, market rates had kind of peaked out. So
Right.
now at the end of 23, I think we are at the fag end of the rate hike cycle. So
Okay.
therefore, rates should be stable to lower in the next year.
Also, Jaju sir, keeping all the triggers in mind and the scenarios that you also explained, it is right to say that mostly this was driven by the international markets and the economic situation over there. What, according to you, has been good for India and our domestic market? Because see, equity markets have touched new highs. Even the bond yields, if we see, have been very range bound. All the triggers that we are getting for the fixed income is mainly from our inflation and from the international economic movement and data that's coming out. But is it right to say, is it safe to say that on our domestic grounds we are still standing strongly? A little bit of concern on the inflation, but RBI is not much bothered about it, and the same kind of mindset is also going to enter 2024, at least domestically, if we have to explain this.
No, certainly. I mean, when we analyze what has been good for India, I think this year the standout point from my perspective was the domestic focus of the Reserve Bank and taking a stance which is considering the domestic factors. So let me just give you a specific example. As we just discussed, Fed hiked the policy rates 4 times from February to October by 25 basis points each, by a cumulative of 100 basis points. RBI went on the pause mode in the February policy until October, when Fed was hiking 4 times. RBI took a preemptive stance in February that based on the domestic inflation trajectory, based on the forex reserves that we hold, there is it's appropriate to now wait and watch as to how the past monetary policy actions have reacted. And that stand has stood out very well, because today India is now poised to grow at 7% for FY24 based on the revised upward numbers by the Reserve Bank. And while the inflation in India has been a little bit on the higher side, the target for the Reserve Bank is 4 to 6%. So if you look at the last 2.5 years, I think there are a couple of months when the inflation has been higher than 6%, that too largely driven by the food prices. But by and large, inflation has been within 4 to 6%, although closer to the 6%. Whereas for Fed and other central banks, the inflation has remained much higher than the central bank target. So even as of today, the Fed's target is 2%, and the last reported number for inflation in US is somewhere around three quarter, three half band. So still 50%, more than 50% higher than their target. I think the position taken by India to stand against the global trend, I think that is the remarkable standout feature for the current year. And going forward, the economic growth looks very strong. The inflation is likely to come down. RBI has been able to successfully guide the market through a period of volatility in the inflation. So we saw the inflation at around 7.5% just a couple of months back. Now it is closer to 4.9%, and this month's inflation number, when they're reported in the next couple of days, we're expecting that to be closer to 6%. This volatility in the inflation has been driven by the highly volatile food and vegetable prices. The core inflation has reached, and I think again the second standout feature is how calm our market has remained, like you mentioned, the range bound yield. So we could also have, like US, gone from 4% to 5% on 10-year and come back to 4% in a matter of 3 months. How upsetting and disruptive is that for a corporate treasurer or for the financial market participants, bond traders? It's very difficult to imagine. So we have to consider the stability that the Indian markets have had this year because of the strengths of India, and because of the astute way in which the monetary policy has been conducted. So I think we have come a long way in terms of asserting ourselves as an independent, market, one of the largest market in the world.
Jajoo sir, let's analyze the first few quarters of 2024. Now, what are the triggers according to you? We are talking a lot about rate cut, but then there are reports. In fact, earlier when I spoke to you, even you were of the belief that we will not see rate cuts happening very soon. So, the wait is extended by one more quarter, almost 6 to 8 months to wait now in 2024 for the rates to start cutting off. The central banks thinking about a rate cut.
So in that case, my sense is that we are not looking at any immediate rate cut. So again, while I spoke very appreciatingly about how we as a country are taking our independent assessment, we are still not dealing from the global markets. I mean, we are still a country with a large current account deficit. We are still a country with a huge dependence on the import of commodities, and we are still dependent on the capital flows to balance our current balance of payment. So we cannot be completely delinked from the global markets, and in the global markets still the scenario is one of uncertainty. We have number of geopolitical events simultaneously happening. So why, apart from Israel and Hamas and the Russia Ukraine, there was a report in the newspapers yesterday of a flash off between the Philippines and the China water ships. Then there is a news of the attack on the US embassy in Iraq. So there are a lot of geopolitical situations which can become disruptive anytime. Uh, the Fed still continues to withdraw liquidity from the system through its quantitative tightening tool, even though they may not hike rates. So it is too early to start expecting a rate cut to happen. And then in case of India in particular, there is a certain development that last year around the same time, US inflation was higher than our inflation, and the Fed was at 2.5%. We were already at 6.5%. This time, the Fed is at 5.5%. Our repo rate is at 6.5%. So the difference between the US policy rate and our policy rate has narrowed significantly. Whereas our inflation now is closer to 5%, their inflation is at 3.5%. So the inflation equation has got reversed. So we are now operating at the very edge. We need to be, very, very watchful that those differences come back to a reasonable level, which means that if the Fed were to cut rates by, say, the first 50 or 100 basis points, it may not leave any margin for the Reserve Bank to cut rates. The second point is that, even today, the RBI's projections for the full FY25 inflation, which means the next year's inflation, is still closer to 5% or higher. So that doesn't bring them any closer to the 4% target that they talk about. Therefore, again, the possibility of a rate cut diminishes looking at that factor. And finally, I mean, in our case, the borrowing continues to be still very large.
Right.
3 years after the COVID, we still have close to 6.5% fiscal deficit on a
Right.
much larger nominal GDP. So in the last 2 years, our overall absolute borrowing numbers has remained unchanged by and large, even though the percentage fiscal deficit to GDP has come down because GDP has grown a little bit. in the next year also,
Mm-hmm.
we have to see how much the fiscal deficit comes down by. So the pressure on the market to continue to absorb large supplies will be there. Obviously, there is talk about the index funds of bringing in money into India after the JP Morgan the bond index inclusion and talks of Barclays and Bloomberg index also considering. So all in all, we are in an environment where the rates are unlikely to go up. But then, is there a possibility of very quick rate cut? I don't think so. So we have to wait till until at least June 24 to see what we can expect, because of the simple reason that now in February we are not going to have a full year budget. It will be a vote on account. Then when the new government comes and the full year budget is presented in June, July, that's the time we can say if there is an environment building up for a rate cut. So I would say for the next 6 months, first half of 2024, no change in the policy rates. Then I think the room opens up if the inflation comes down for a rate cut by the Reserve Bank in the second half of 20.
All right, I think that will be all as far as debt portfolio, debt scenario is concerned in 2024. Thank you so much, Jajoo sir, for being on the show and helping our viewers with this today.
Thank you.